Imagine you've finally decided to start investing seriously. You've saved up some money, you've done a little research, and two options keep coming up everywhere: dividend stocks and index funds. One side says buy dividend stocks, get paid every quarter, build passive income, watch the money hit your account without selling a single share. The other side says just buy index funds, stop overcomplicating it, let the market do the work. And both sides have people who swear by their approach. Both sides have charts. Both sides have stories. So you're sitting there wondering, which one is actually better? Which one builds real wealth? And which one is right for someone like me? Here's the thing. That's actually the wrong question, because the better question isn't which one wins. It's what each one is actually doing for you. And once you understand that, the answer becomes a lot more personal and a lot more clear. Hi, I'm Rishi. And today we're breaking this down chapter by chapter. What dividend stocks actually are, what index funds actually do, the real numbers behind both, and how to figure out which one fits where you are right now. No hype, no agenda, just the full picture. Let's get into it. Chapter 1. What are dividend stocks? Let's start from the beginning. A dividend stock is a share in a company that pays you a portion of its profits regularly, usually every quarter, sometimes every month. Think of companies like Coca-Cola, Johnson & Johnson, Procter & Gamble. These are businesses that have been around for decades. They're not growing explosively anymore, but they're incredibly stable. And because they're not reinvesting every dollar into rapid expansion, they share the profits directly with shareholders. That payment is the dividend. So if you own 1,000 shares of a company paying $2 per share annually, you receive $2,000 a year, just for holding the stock. No selling, no timing the market. The money arrives whether the stock price goes up or down. And that's the appeal. It feels like income, because it is income. According to Hartford Funds research, from 1940 through 2024, dividend income contributed an average of 34% of the S&P 500's total return over that entire period. That's not a small number. Dividends aren't just a bonus. For decades, they've been a significant driver of real wealth. But, and this matters, that contribution varies a lot depending on the era. In decades where the stock market grew explosively, like the 1990s or the 2010s, dividends were a smaller slice of total returns, because capital appreciation, the stock price going up, did most of the heavy lifting. In slower decades, dividends kept total returns alive. That context is important. Chapter 2. What are index funds? Now let's talk about index funds. An index fund doesn't try to pick winners. It just owns everything. When you invest in an S&P 500 index fund, you're buying a tiny piece of the 500 largest companies in the United States. Apple, Microsoft, Amazon, Google, Berkshire Hathaway, all of it in one purchase. And here's the beautiful part. You don't need to research individual companies. You don't need to follow earnings reports. You don't need to worry about whether one company cuts its dividend. You just buy the fund and let the entire U.S. economy work for you over time. The S&P 500 has delivered an average annual return of around 10 to 12% historically, including dividends reinvested. That's through recessions, crashes, pandemics, rate hikes, all of it. And the fees? Index funds are some of the cheapest investments you can own. Vanguard's S&P 500 Index Fund charges an expense ratio of just 0.03% annually. That means on a $10,000 investment, you're paying $3 a year in fees. Compare that to actively managed funds charging 1% or more, and the difference compounds into a genuinely significant amount over decades. The index fund is the definition of simple, broadly diversified, low cost, long-term, and backed by decades of data showing it beats most active investors over time. Chapter 3. The real numbers. Okay, let's actually compare the two honestly, because this is where most people get surprised. Let's say you invest $500 a month into a dividend portfolio yielding around 4% annually, and you reinvest those dividends. Over 30 years at modest overall growth, you'd build a meaningful portfolio that also generates increasing income over time. At 4% yield on a $400,000 portfolio, that's $16,000 a year in dividend income income paid to you regularly without selling anything. Now, let's say instead you put that same $500 a month into an S&P 500 index fund at a historical average of around 10% annual return over 30 years. That grows to roughly $1.13 million. On paper, the index fund grows larger, but here's what that comparison misses. The dividend investor isn't just chasing a final number. They're building a cash flow engine. Month after month, year after year, the dividend income starts small, but as you add more shares and the companies raise their payouts over time, it compounds into something that can genuinely replace a paycheck. These are two different goals, not two different quality levels. One is building the biggest pile, the other is building a reliable income stream. And depending on where you are in life, one of those goals matters more than the other. Chapter 4. The psychology behind each one. Here's something worth talking about honestly. Investing isn't just math, it's behavior. And your behavior over 20 or 30 years matters more than any return percentage. Index funds are simple, but simple is harder than it sounds. When the market drops 30% and your portfolio is down $40,000 on paper, doing nothing is psychologically brutal. Everything in you wants to act, to sell, to protect what's left. And the people who panic sell, they lock in the loss, then miss the recovery, then regret it for years. Behavioral economists call this the disposition effect, the tendency to sell falling assets too early and hold winning ones too long. Indexed fund investing only works if you can sit through the volatility, which most people struggle with more than they expect. Dividend stocks have a different psychological effect. When the market drops, your dividend still arrives. That quarterly payment hitting your account is a tangible reminder that something is working, even when the number on screen looks scary. For a lot of investors, that regular income signal makes it easier to hold on, easier to stay calm, easier to not make the emotional mistake that wipes out years of compounding. That psychological stability, it has real financial value, even if it doesn't show up in a spreadsheet. Chapter 5. The tax reality. Let's talk about something most comparisons skip: taxes. Because how you're taxed on each strategy is genuinely different. With an index fund, if you're not selling, you're not triggering a taxable event. Your investments grow. You pay nothing until you actually sell. That tax deferral is powerful. It keeps more money compounding for longer. With dividend stocks, every time a dividend is paid, it's a taxable event, even if you immediately reinvest it. Qualified dividends are taxed at a lower capital gains rate, 0%, 15%, or 20% depending on your income, which is favorable compared to regular income tax, but it's still a tax bill every single year. And over decades, taxes taken annually versus taxes deferred until retirement can make a meaningful difference to your final number. This doesn't mean dividend investing is bad. It just means where you hold dividend stocks matters. In a tax-advantaged account like a Roth IRA or a 401k, dividends grow without the annual tax drag. That's the ideal structure for a dividend strategy. In a regular brokerage account, you'll want to factor in the tax impact on your real returns. Chapter 6. Who each strategy is actually for. So after all of that, here's the honest breakdown. Index funds tend to make more sense if you're in your 20s or 30s. You're in the wealth building phase. You want simplicity. You don't need your investments to generate income right now, and you're comfortable with volatility in exchange for long-term growth. For most people in this phase of life, a low-cost S&P 500 index fund consistently invested over time is genuinely hard to beat. Dividend stocks tend to make more sense if you're approaching or already in retirement. You need your portfolio to generate regular income. You find it psychologically easier to hold when you're receiving payments, or you're specifically building toward a point where dividends replace your salary. For someone who wants to retire early and live off investment income without selling shares, a well-built dividend portfolio is a genuinely powerful strategy. Neither of these is a shortcut. Neither of them works without consistency and time, but they serve different seasons of a financial life. And the smartest investors, they often use both. Index funds to build total wealth efficiently in the early years, then gradually shifting toward dividend-paying investments as income needs grow later. Chapter 7. Here's what this debate really comes down to. It's not dividend stocks versus index funds. It's growth versus income, future wealth versus current cash flow, building the pile versus using the pile. And the answer to which one you need depends entirely on which stage you're in. According to Morningstar data, dividend strategies actually outperformed the broader market in 2025 year to date, after lagging in 7 of the previous 8 years, which is a perfect reminder of something important. No strategy wins every single year. Not dividends, not index funds. What matters is understanding why you own what you own, and having enough conviction in that reason to stay the course when things get uncomfortable. Because here's the truth that applies to both strategies equally. The investor who stays consistent over 25 years almost always builds more wealth than the investor who chases the better performing option every few years. Consistency beats strategy every time. So the next time someone tells you one of these is obviously better than the other, ask them one question: better for who and better for what goal? Because that answer changes everything. If this helped you think about investing a little differently, don't forget to subscribe. I'll see you in the next one.